Stop scrolling and think about the last time you looked at your paycheck. You know that sinking feeling when you see how much disappeared before it even hit your bank account. That isn't just the cost of living, that is the price of not knowing the rules. We are taught that taxes are fixed, but for the wealthy, taxes are a game they win and you lose. Today, I'm breaking down the exact strategies, from buying the right SUV to firing your lazy accountant, that can put tens of thousands of dollars back in your pocket this year. I'm Tax Hack Pro, and it's time to stop the bleeding. Let's be honest for a second. There is one word in the English language that ruins your mood faster than any other. It's not a swear word. It's 5 letters that appear on your pay stub and make your heart sink every single time. Taxes. It feels worse than a 4-letter word, doesn't it? As a WTO employee, you often feel like you have a target on your back. You make the money, they take the money, and you have zero control. But there is a secret the wealthy know that you don't. And listen, if you're tired of watching 30 or 40% of your cash vanish and want to learn the secrets to keeping it, do yourself a favor and hit that subscribe button to Tax Hack Pro right now naturally. We are building a community of people who refuse to be victims of the tax code, so join us. Now, let's get into the reality of the situation. The biggest lie we are told is that employees are helpless. We are told, well, your employer takes the taxes out automatically, so there is nothing you can do. That is false. If I was a WTO employee right now, the very first thing I would do is start a business. I don't care if it's small. I don't care if it's a side hustle. You need to create a legal entity. Why? Because the moment you have a business, the tax code opens up to you. As an employee, you spend money after taxes. You buy your car, your gas, and your computer with what is left over. As a business owner, you spend money before taxes. You buy the car, the gas, and the computer first, and you only pay taxes on what is left over. This isn't a loophole, it's how the game is played. You need to find mechanisms that offset your taxes so you keep more of the money you earn. I don't care what income level you are at, that is the game everybody should be playing. But before we talk about the specific write-offs, we need to talk about the person handling your money. I got really good advice years ago. Don't cheap out on your accountant. Their sole job is to make you money. Most people treat their accountant like a mechanic they only see once a year when the car breaks down. They hand over a pile of receipts and ask, "How much do I owe?" That is a recipe for poverty. Accountants should be proactive. They should be coming to you saying, "Hey, you should be doing these things." When accountants are just order takers, that is not helping you. I had a bad accountant years ago, and I finally looked him in the eye and asked, "Why am I the one asking you these questions? You should be telling me these things." You want an accountant who is proactive with what is going on in your life, finding ways so you don't have to pay as much money to the government legally. So let's talk about the specific strategies, starting with one of the most powerful ones, the company car. I am always shocked when I see independent contractors or business owners driving sedans. I just don't get it. Why are you driving a car that offers almost no tax benefit when you could be driving a vehicle that creates a massive tax loss? Let's talk within reason here. I'm not telling you to buy a private jet. I'm talking about purchasing a vehicle of a certain weight, specifically over 6,000 pounds. If you are a WTO employee, this is why you start that side company. You own the company buys the car, and now you have write-offs that offset your ordinary income. If you pay too much money to the government, they give you a refund check. Now, a quick note on that. People get excited about a tax refund. It's nice to get a check, but all that really means is you overpaid throughout the year and gave the government an interest-free loan. We want to stop doing that. Here is how the vehicle strategy works. It's impactful and it's immediate. If you go out and purchase a $50,000 SUV that qualifies for the weight deduction, you can use that $50,000 against your income. Let's look at the math. If you make $100,000 this year and you buy a $50,000 vehicle for business, you now effectively only pay taxes on $50,000. That is significant. It doesn't just lower your taxable income, it likely drops you into a lower tax bracket. You might go from paying 32% to paying 25%. You could go from owing $32,000 to Uncle Sam to owing $12,000. You just saved $20,000 in real cash just by buying the car you needed anyway. That is the power of understanding the rules. Now, let's look at investments. When people ask me about residential versus commercial real estate, I always say the same thing. I'm not saying you can't make money in residential, but you are very limited. Buying a single-family home means dealing with tenants, toilets, and hoping the market goes up. If you want to offset ordinary income, you need to look at commercial properties. And a lot of people think, I can't afford an apartment complex. No, you don't buy the building. You invest into funds that buy the building. You participate in the deal. By participating, you become a partner, which means at the end of the year, you get a tax form called a K-1. That K-1 is magic. In the first year, it often gives you a boatload of what is called depreciation. You use that loss against your income. So go back to our example. You made 100 grand. You bought the car, so now you're at 50. Then you make a $20,000 investment into a commercial building fund. That investment might fast forward $12,000 of depreciation losses to you. Now, you are only paying taxes on $38,000. Your tax bracket drops again. Maybe you are down to 22%. Now your tax bill is $7,000. You went from owing 32 grand to owing 7 grand. And the best part, you still own the car, and you still own the investment that is paying you interest. That is how the wealthy stay wealthy. They use vehicles of investment to accelerate depreciation and mitigate tax liabilities legally. But you have to do this within the calendar year. You can't wake up in April and decide to buy a car for last year. You need to be thinking about this in October, November, and December. There is another strategy that is sitting right in your garage. Look at the stuff around your home. Donations are a massive write-off, but I'm not just talking about dropping off old clothes. I'm talking about personal property. We remodeled our home recently. We had old lights, fixtures, cabinets, a ton of stuff. Most people would throw it in a dumpster. I looked at it and saw a tax deduction. We had an appraiser come out to value the materials, and we donated them to a charity. I think the appraised amount was something like $160,000. Think about that math. If my tax rate is 40%, and I get a write-off for $160,000, I just saved over $60,000 in real money that I don't have to pay the IRS. That is money in my pocket just for being smart about what I donate. The game is played on the margins. It's about asking, how do I keep more of what I earn? Everyone's situation is different, and I am not giving you specific legal advice. I am telling you to get a proactive accountant who can give you that advice. If you ask your accountant, how can I mitigate my tax bill? And they say, I'm not sure, get a new person. Immediately, proactive accountants will save you an incredible amount of money. Whether it's starting the side business, buying the SUV, investing in commercial funds, or donating assets, the opportunities are all around you. You just have to be willing to play the game. So be smart. We are always approaching a deadline. Make the decisions that offset your income. Keep your money, build your wealth. And remember, it's not what you make, it's what you keep. If this helped you see the tax code differently, share this with a friend who needs to wake up. I'll see you in the next one.